Hello everyone, hope you all are doing well and you're staying healthy. In this video, I'm going to talk about health, but from the payroll exam point of view. So we will talk about health insurance, accident and retirement benefits. This video is also in the question and answer format. It's easy to remember things that way for me, so I have put all those question and answer list on this video. So let's get started. Just want to give you a little background of health insurance. Most of the mid-sized and large employers provide some type of health or medical insurance to the employees. There are several types of healthcare plans offered by employers, and the main one that you might know are the HMO and PPO. Talking about HMO first, what is HMO? HMO stands for Health Maintenance Organization. It is a healthcare system that provides healthcare but does not directly pay for it, as does the health insurance carrier. The HMO provides these healthcare services on a prepaid basis, with employers contributing to the plan on behalf of employees choosing the HMO option. These plans generally do not involve deductibles or complex claim procedures, but they limit members to using HMO doctors and hospitals. So there are two kinds of HMOs, the traditional HMO and point of service HMO. Traditional is the one that has its own healthcare facility or facilities, and patients have to go there to receive the medical services. And point of service is the option that allows covered employees and their dependents to use non-HMO healthcare providers with the inclusion of deductibles and insurance co-payments. Now, let's talk about PPO. What is a PPO? PPO stands for Preferred Provider Organization. It is a kind of healthcare delivery system that gives participants a choice of higher level of benefits and lower out-of-pocket costs if they use the doctors who are part of PPO network. If the employees use out-of-network providers, the employees' cost in terms of deductibles and co-payments are significantly higher. Now let's discuss some more questions. Under the Affordable Care Act, when is the coverage not affordable for the employee? If the employee's share of the premium for employer-provided coverage would cost the employee more than 9.78% of that employee's annual household income in 2020, the coverage is not considered affordable for the employee. So it has to be less than 9.78 of the employee's annual household income. And the rest of the contributions are made by the employer. Now, how would the employer know what is the annual household income of the employee? So there are some affordability safe harbor that are provided, and there are 3 of them. So what are these affordability safe harbor? The 3 affordability safe harbors are as follows. First one is the W-2 wages safe harbor, which generally is based on the amount of wages paid to the employee that was reported on box 1 of the employee's form at the beginning of the year. Then Second is the rate of pay safe harbor, which generally is based on the employee's rate or salary at the beginning of the coverage period with adjustments. And the third one is the federal poverty line safe harbor. This generally treats coverage as affordable based on the federal poverty line amount for a single individual for the applicable calendar year. And what is the federal poverty line amount? For 2020, for one person household, it is $12,490 annual income. And if you do the monthly maximum contribution by the employee on the health insurance, it should not be more than $101.79 as per the federal poverty line. Next question is, what is the tax treatment of the contributions to accident or health insurance plans? Now, to the health insurance plans, the contributions are made both by the employer and employee. You see that the deductions coming out from your check, you make those deductions for your health insurance, right? So the employer also contributes. Employer's contributions are generally contributions made by the employer to an accident or health insurance plan providing insurance for its employees, and their spouses and dependents are not wages. So they are not considered wages. That's why they are not subject to federal income tax withholding or Social Security, Medicare, and future taxes. So the contributions that are made by the employer by law, they are not considered wages, they are not benefits. So they are not subject to federal income tax withholding and other employment taxes. They are excludable from employees' income as they are not considered wages. Now let's talk about the employees' contributions. Employees' contributions that are not through salary reduction cafeteria plan are included in income for all taxes. Means that the employee make contribution with after-tax money. The aggregate reportable cost of employer-sponsored health insurance is reported on Form W-2 Box 12 with the code DD. Now, we are talking about the cost of health insurance, and the code is used DD. It is going to be hard to remember the code. So, the mnemonic that I use for that is dental doctor for the health contributions. Okay, now this aggregate reportable cost, it includes both the portion of the cost paid by the employer and the employee, regardless of whether the employee paid for that cost through pre-tax or after-tax contribution. So this box includes both the employee and employer contributions. There are some things that are not included in aggregate reportable cost, which may sound like the health insurance costs, but they are separately reported somewhere else on W-2. And those costs are Archer Medical Savings Account, Archer MSA. Try to remember medical saving account as Archer MSA because the questions might be asked regarding Archer MSA or MSA. You should know that they both are same. Health saving account, multi-employer plan, health reimbursement arrangements, and health flexible spending arrangements. So these 5 things are not included in aggregate reportable cost. Are the benefits received by employees under the accident and health insurance plans included in income? Now, first we were talking about the contributions. Now we are talking about the benefits. The benefits that are received by the employee under accident or health insurance plan that directly or indirectly reimburses the employee medical expenses incurred by the employee and his or her spouse, dependents, and children who have not reached the age of 27 at the end of the taxable year are not included in employees' income. So, for health insurance and accident, both the contributions and the benefits are excluded from employees' income. Now let's talk about the medical saving account MSA or Archer's MSA. What are those? So, employees of small employers who are covered by the employer sponsored high deductible health insurance plan can make tax deductible contributions to medical savings accounts or to have the employer make contributions on employees' behalf that are not included in employees' income. These are referred to as Archer MSAs. Let me go over it again. Employees of small employers. So, small employers who are considered small employers if they employ no more than 50 employees are small employers. And those employers are covered by employer sponsored high deductible health insurance plan. So, if that is the situation, then the employees can make tax deductible contributions to the medical savings account, or the employer can make the contributions on employees' behalf. And they are not included in employees' income. Two things to take away from here. Small employers are the employers who employ no more than 50 employees. The other thing is that the contributions to the MSA account can be made either by employee or employer, and they are not included in employees' income. In order to be eligible to make the contributions to MSA or to have the employer make the contributions on employees' behalf, the employee must be covered only by the high deductible health insurance plan. So, this Archer MSA is only for the employees who are covered with the high deductible health insurance plan. For 2020, the IRS defines high deductible plan as any plan with a deductible of at least $1,400 for an individual and $2,800 for the family. The high deductible health plan's total yearly out-of-pocket expenses can't be more than $6,900 for the individual and $13,800 for the family. Contributions to MSA can be made either by employee or the employer, but not both. Employer contributions are excludable from income and are not subject to federal income tax withholding and other employment taxes with certain limitations. Employer contributions to the employee's MSA must be reported on Box 12 of the employee's Form W-2 with the code R. So the Archer MSA is reported in Box 12 with code R. So Archer MSA code R. Just try to relate it, the Archer in the sound Archer with code R, just to remember it. Employee contributions to the MSA are taxable, but I can take deduction on personal tax, but the employee can take deduction on personal tax return. So the employer contributions are excludable, but the employee's contributions are taxable, and the employee can take deduction on the personal tax return. Means the employee will make the contribution with after tax money, and he will take the deduction on 1040. Employees' contribution to Archer MSA are subject to federal income tax withholding and Social Security Medicare taxes and must be reported in box 1, 3, and 5 of W2. 1 is for federal income tax, 3 is for the Social Security, and 5 is for your Medicare taxes withheld. Sorry, Medicare tax income. Now let's talk about the long-term insurance. What is long-term care insurance? The long-term care insurance is generally treated as the accident and health insurance contract. Therefore, the amounts received under such contracts are excluded from income as amounts received for personal injuries, sickness, and reimbursements for medical expenses. So, long term, the benefits are excluded. They are just treated as the other accident and health insurance. The benefits are excluded if they are for personal injuries, sickness, reimbursement of medical expenses. What is the per diem excludable amount for long term care insurance in 2020? Per diem means per day. Excludable amount for long term care insurance is $380 per day. Can be excluded. More than that, it is included in income. How much time does the employee have for making the decision of COBRA selection? COBRA. This is the something that is given to the employees who are actually terminated. They are given some grace period to decide if they want to keep the medical insurance that they have through their employer or not. So the question is asking that how much time do they have for making the decision about COBRA selection. The employee and other qualified beneficiaries who wish to take advantage of continued group health plan coverage must make an election for such coverage, and the election period must last for at least 60 days and can begin no earlier than the date on which the coverage was terminated because of the qualifying event. So that 60 days period begin not when the employee is terminated, but it begins when the on the date on which the coverage was terminated. Okay. I will talk about this COBRA thing and the qualifying event also. Just to give you an idea, I don't know if I have the question on the list, but the qualifying events for the COBRA are as follows. Like if the employee gets terminated, then under COBRA his insurance will be covered for 18 months, and it will be covered for 24 months if the person is in military service, and that coverage is extended to 36 months if another qualifying event occurs during the period. Then the second qualifying event could be employer's bankruptcy. If the employer got bankrupt, then under COBRA, the employee or the retiree will be covered for his whole life. And if the retiree dies, the period of continuation for the retiree's spouse and children is 36 months from retiree's death. Another event could be employees termination or reduction in work hours, and the qualified beneficiary is disabled. So if the disability is also the case, then the COBRA will cover for 29 months, and with the extended period of 36 months if another qualifying event occurs. And the last one is employee's death, divorce, separation. Then the COBRA coverage is for 36 months. How are the health reimbursements? Sorry, what are the health reimbursement arrangements? They are the employer provided health benefit, and the employer provides reimbursement up to a maximum dollar amount. What is a health saving account? Health saving account is a tax favored saving account designed to help employees save for medical expenses while they are employed if they are covered by the high deductible health plan. So if the employee is covered by the high deductible health plan and he wants to save some money for for his future health, then there is the account called health savings account, and the employee can put the money into it. The contributions to the HSA by the employee up to the maximum annual contribution limit are tax free, means that is pre-tax dollar contribution. So the employee can contribute to HSA pre-tax. And the employer contributions up to the maximum annual contribution limit are excludable for all taxes, means employer's contributions are not taxed to the employee. They are reported on box 12 with the code W. So health saving account, and that is for the future. You're going to use it in the future, but you're saving it for your health. And the code is W. How will we remember that? So W means you're weak, you're on a wheelchair, or using a walker to walk. So you can use any code that you want to remember that this is for your health, your future health saving. So, and the employer's contribution above maximum dollar limit go on box 1, 2, 3, 4, 5, 6 of W2, means that is taxable. Now let's talk about the HSA contribution limit for 2020. If it's a single coverage, then both the employer and employee contributions should be not more than 3550. I mean, they will get a exclusion from income only if it is up to 3550, and for family it is 7100. If the employer or employee contributes more than that, then that is taxable. HSA catch-up contributions for 2020 for the employees who are more than 55 years of age, it's $1,000 for single and 1,000 for family. So the contributions up to these amounts are tax free, but more than that it will be taxable. Okay, you can only use your HSA contributions for qualifying medical expenses. What is family and medical leave? Family and medical leave, which is abbreviated as FMLA, it applies to the private sector employers with 50 or more employees. Family and Medical Leave Act allows employees to take up to 12 weeks of unpaid leave in 12 months to be with the newly born or to take care of a ill family member or for themselves. So they will not lose their job, and their health benefits will also continue if they take 12 weeks leave, though it is unpaid. Employers can require the employee to use accrued paid vacation, personal sick, or family leave as a part of 12-week guaranteed leave. So the employee is not entitled to accrue any benefits or seniority under the FMLA leave. Employees are responsible for the premiums during leave if they want to continue the coverage. So they can, their job is secure even if they are on leave for 12 weeks in the year, but they will have to, they are responsible for contributing to the premiums of for the health insurance, and they will not accrue any of the uh, benefits during that time. Are the permanent disability benefits taxable to the employee? Permanent disability benefits received by the employee are taxable. They are subject to federal income tax withholding, and they are also subject to the employment taxes to the extent the employer paid premiums or employee paid premiums with pre-tax dollars. So if the contributions were done by the employer to the permanent disability account, and the employee also contributed with the pre-tax dollars, then the benefits will be taxable. Amounts paid on or after the employment relationship has been terminated because of death or disability retirements are not subject to Social Security, Medicare, or FUTA taxes. What is intermittent leave? Intermittent FMLA leave can be taken as reduced hours or may be deducted from an exempt employee's salary without converting the employee into non-exempt employee under FLSA. Now, this is a big topic, sick pay. What is sick pay and what are the tax implications? So, when we talk about the sick pay, like if you are sick 1 day or 2 days in a week, then it's generally taken out from your sick bucket, the accrual bucket, and you are paid for that, and you pay all the taxes on that, right? So if the sick leave is very small, it is covered by the employer provided paid sick days during which the employee will receive the regular salary, and it is subject to all taxes. Now, if the employee is sick for a longer period of time and has no paid PTO days left, then they are forced to take unpaid leave. And if the PTO days are used and the employee is still out sick, then they usually receive a wage replacement through employer's sick pay plan in form of short-term or long-term disability payments. So he goes on short-term disability. The payments may be made by the employer, the employer's agent, or third-party insurance company. Now, whether the payments made to the employee under sick pay or disability plan are taxable income to the employee depends on how the plan is funded. So, if the employee contributed towards the funds with after-tax income, those are not taxable again because he already contributed with his after-tax money. Benefits attributable to employer contributions or employee pre-tax contributions are taxable. Other important thing is that employment taxes for 6 months payments and federal for all payments, meaning that whatever is taxable, the employment taxes will be withheld for the payments that are made to the employee for 6 months, And if they are made for the longer than 6 months, then no more employment taxes will be withheld after 6 months. But federal tax will be withheld from all the payments that the employee received under the disability. And then there's a formula for calculating taxable benefits when both employer and employee contributed. And the formula is that the taxable amount is equal to uh, contributions made by the employer divided by contributions made by the employer and employee. So, contributions made by the employer divided by total contributions. Uh, because we just want to know the percentage of the contributions that are made by the employer, and we want to pay tax on that because that needs to be taxed. If the employer's sick pay plan is self-insured, the employer must withhold federal income tax on all payments made to the employee and must withhold employment taxes on payments for 6 months. So only for 6 months, all the employment taxes should be withheld. After that, do not withhold the employment taxes, meaning the Social Security, Medicare, and FUTA taxes. But you will still withhold federal income tax. If the employer makes the payments, they must report all taxable amounts on their quarterly 941 and Form 940. The taxable amount must also be reported to the employee on Form W2 in Box 1, 3, and 5, and non-taxable amounts attributable to the employee contributions in Box 12 preceded with code J. So sick payment contributions, code J. Sick, you can use jaundice to remember code J. If the payments are made by the employer's agent, considered as payments made by the employer. So the agent will withhold federal income tax at the flat rate of 22% and 37% if the year-to-date earnings are more than 1 million. The employer will be responsible for the employment taxes. Okay, when the payments are made by the third party and third party bears the risk of insurance, means the third party will withhold federal income tax if the employee requests by filing W4S. So if the third party bears the risk of insurance and the payments are also made by the third party, then the third party will withhold federal income tax only if the employee requests for withholding by filling the form W4S. The agent will withhold the FIT only if the employee receives at least net $10 after withholding. Means on the W4S, the employee can ask for a flat amount, but if after taking out that flat amount, the employee is less than $10 of the net payment, then that federal income tax will not be withheld. The third party must withhold and pay over the employee's share of Social Security, Medicare for each payment made within 6 months after the end of the last month the employee worked for the employer. The third party is also responsible for employer's share of Social Security and Medicare taxes and FUTA. And if the third party insurer makes the payments, the third party must report taxable amount of sick pay on their quarterly Form 941. All payments should be reported on 940, and the taxable amounts must be reported to the employee on Form W2. The checkbox third party sick pay must be checked on box 13 of W2. Are the permanent disability benefits taxable? The permanent disability benefits are income to the employees, and they are taxable to the extent the employer paid premiums and employee paid premiums with the pre-tax dollars. Is workers' compensation taxable? Now, initially, when we were talking about the sick pay, it was that was for the non-job related accident or something like that, when they get the payments from the disability plan. But when we talk about the workers' compensation, it is job related accident or injury, and the employee has sued the employer, and then the employee might get the workers' compensation. So, workers' compensation is a form of insurance. Employers are generally required to buy it to insulate them against the lawsuits brought by employees who are hurt or become ill while working. Payments received as workers' compensation benefits are not included in employees' gross income and are not subject to any employment taxes. This exemption applies only to amounts received as compensation for injuries or illness suffered on the job, and only to the amount that do not exceed the benefits provided under the applicable state or federal workers' compensation law. So I think that's all for this video. It's a lot of material. You have to remember a lot of W2 box 12 codes. Just a review, I'm going to go over the W2 codes. So the first one that we did was for health insurance contributions. The aggregate reportable cost of employer sponsored health insurance is reported on box 12 of W2 with the code DD for health insurance, right? And the mnemonic that I use is dental doctor for health insurance, medical coverage. Okay, and then the next one was that we did was R, code R. Code R on W2 for the employer's contributions to Archer MSA. So the code R is for Archer MSA. Next one that we did was for health savings accounts for medical expenses, future medical expenses. The code is W, and we can use week, walker, wheelchair, etc. Then the next one that we did was code J. Code J is for sick pay. And that's all. So hope this helps you. Try to go over this video, listen to it, so that you get the information that you want to retain. And I'll see you in the next one. Goodbye for now.